Hello, Steve Lentz here with the Prepared Mind. This is for Tuesday, May 31st, 2016. Presented material is for educational purposes only and should not be construed as personalized financial advice. And past results are not necessarily indicative of future performance. Today, we will give you two reports. One is the Butterfly Condor Timing Report for the S&P 500, and also we're going to go over the Directional Likelihood Report. Both of these reports use very unique approaches to technical analysis and price action to give you some great statistical information in helping you make better decisions about how to trade the S&P 500, probably from a premium selling standpoint in a delta neutral sense. This video blog, is part of the text blog that you can see at discoveroptions.com. Click the blog link and that'll take you to Frank Fahey's Prepared Mind entry for May 31st. There you'll find some great information on volatility, the broad market in general. In addition, he also has every single week a nice candidate list for double calendar trades coming out with the earnings on some stocks in the near future here. Okay. Also, if you are new to us and you want to subscribe, please click on the button below. Love to have you as a subscriber. And also, if you want something for free, you could go to the Discover Options website and get a free book, Simple Steps to Options Trading Success. The link for that is in the upper right. Okay, and that's a nice book co-authored by myself and Jim Graham in our office, and I think you'll find that very helpful. Okay, on to the reports. Two reports. We're going to address the Condor and Butterfly Timing Report. A very interesting positive edge that you'll see. We're going to walk you through how we do this. Let's look at the current market condition. All right, the current market condition we like to define using up to 4 different parameters. First, we'll look at the price action, then the trend, the overbought oversold status, and then also the average true range. Price action, we can see that the high on Friday was above Thursday's high. Same thing with the low, higher than the previous day's low on Thursday, and the close was also higher as well. All this occurred above the 50-day simple moving average. Also, the 15-3 stochastic is well over 60, and it's above its 3-day moving average as well there. So kind of in the overbought area, getting up, it's actually pushing up pretty close to, I think it's around 90 or even higher. It's very, very high. Okay, so we're in the overbought area technically, but we're still above the moving average. Now, in terms of average true range, we need to be careful here, and I don't always use the average true range. It just depends on the market condition, and I customize these 4 categories to try and make sure that we can get a large enough population to get something statistically relevant. But in any case, the last 2 days have had their average true range well under average, in this case well under 1%. All right, in terms of a percentage. And that's just a 1-day ATR expressed in terms of a percentage. So that is the current condition. And the question here, of course, for premium sellers like us is this current condition a good one for selling option premium? What you see here in terms of this market condition, is it good for that? Well, we answer that in the following method. First, we're going to look at the 21-day actual percent move from any close. And I like to chart this in my Metastock program, that you can see the red line there. And then, and of course, the most recent bars do not have this calculated because 21 days has not yet passed. And so we're always 21 days behind. But then what we like to do, in addition to looking at how far the market moved from any given close, we look at the implied volatility expressed in terms of the VIX. Now, all our work is done using a skew adjusted VIX, one for the upside, one for the downside. All right, but in terms of the VIX, you can see here that the 21-day implied move from the VIX is higher quite often than the 21-day actual move, and that's an advantage of trading the S&P 500 cash options. You have that inherent edge in the long run. Doesn't always work out that way, of course, but we call these favorable bars. Okay, when the implied volatility is higher than what actually comes to pass, that bar in hindsight is labeled either blue for favorable. Okay, it was a favorable time to sell premium when what was being implied in the options turned out to be higher than what actually came about. Right, that's a favorable bar for selling option premium. Now, if a bar turns red, that means that the market moved more than what was being implied by the option prices, and we label that bar unfavorable, or we color it red. Okay, so since January 2000, here's the question. What percentage of these bars have been favorable for selling premium? I imagine you want to know that if you're in the business of selling premium. Here are the stats going all the way back, and this is over 4,000 bars of statistics here. All in all, over 2/3, okay, just over 2/3 of the bars are favorable for selling option premium. Right around 1/3 is not favorable or unfavorable for selling option premium. So that's the baseline statistics, okay? Now, of those bars which align with our current technical condition that I just showed you a little bit ago, what percentage are favorable? Okay, now think about that question. If we find out, if we run a study and we find out that that condition, this one that I just told you about, the one we're in right now, if it turns out that 100% of the time you have blue bars that are favorable, well, then we're going to be selling option premium all day, right? You want to load it up. If, on the other hand, this market condition ends up, it turns out that 100% are always unfavorable, well, then we're going to back off and not sell any option premium neutrally, because we know that the market's very likely to move a lot more than what's being implied. We're in for some rocky seas there, whatever they say. All right, so here are the statistics. If you take our market condition, as it turns out, and this is well over 200 incidences of our market condition coming to pass since January of 2000, 3/4 of them turn out to be favorable. Roughly 1/4 of them turn out to be unfavorable. That's better than the baseline historical of 60s, about 2/3, 1/3. So right now, folks, we have a condor butterfly timing edge of roughly 8.9%, which is the difference between that 75.7 and 66.8. So it's looking good for the premium sellers from a raw statistical historical standpoint, given our market condition as I defined for you. Okay, now on to the likelihood report. We're going to get some directional likelihood for the S&P 500. Before we do that, I want to point out on our website, discoveroptions.com, you could see all the different things we offer. You don't have to pay, thousands and thousands of dollars to just dip your toe in the water and see what mentoring is all about. We offer a 99-cent course, an introduction to options. We have a covered call course for about $200, puts and callers for about $200, and those give you one-on-one instruction, so you can get a flavor for what it's like to have someone hold your hand through some of this material and make sure you understand it, and to help you look at what you're doing and see how it pertains to the models that we've come up with. All right, so give it a look-see. Love to see you at least dip your toe in the water on some other courses before you ramp it up for the full-blown equity tracker futures. So go check that out. Likelihood report. We're going to try and determine the statistical likelihood of the market going up or down given our market condition. And so here's our condition again. And the question here on the table is, since January 2000, how often has this same scenario occurred, and what did the market do? Did it go up, down, or wobble around and not really do much? Okay, and that's the question on the table that we're going to answer right now. We're going to take a look at this exact condition and go back in time. And first we need to understand the historical distribution of price in total. Then we look at that technical scenario and how often price went up, down, or wobbled in the middle. And then we see if there's a big difference and if there's an edge. So here's how we do this. Very quickly, We take 3 sets of volatility bands, 5, 10, and 15 days in the future. These bands are set from the close 1 standard deviation. We use a 20-day historical volatility number, and these are log normally distributed. So here's an example. You have a close, and then you have a band set upward and below it as well. Let me get my little marker. You can kind of see here the upper band goes like this. The lower band, we extend that value out. And we're going to note that from this close, whether the market went up and hit the upper, whether it went down and hit the lower band over the next 10 days, or did it wobble in the middle for the next 10 days and hit neither? Well, in this case, the market clearly went up. There we go. Boom. It went up and hit the upper band. Did you see that? Again, from here, okay, look where the band is on the upside, to there. Boom. In 1 day, it went up and hit that upper band. So in that case, it hit the upper, and we denote in our database that it hit the upper band in that particular case with that close. Now look at the next close that we see over here. Okay, did the market go down and hit the lower band in the next 10 days? Go up and hit the upper band, or did it wobble in the middle? Okay, there it is. And if you look real close, you'll see that it indeed wobbled in the middle. It did try to hit that southward band on the downside, but it did not hit it. So in this case, we denote in our database that it hit neither of the bands. And so what we do then is from every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. And here are the statistics. Okay. You know what? And this is not right. That should be a different value. No, it should be May. That's as of May 27th. There you go. Tell you, copy and paste is the bane of our culture, right? So over the course of 4,164 signals closes, the upper band got struck 29.6% of the time. The upper 10 and 15 roughly 23% of the time. The lower bands got struck right between 29 and 30% of the time, and the lower 15-day band got struck 32% of the time. So these are the baseline historical statistics as to how often price struck each of those 6 bands. All right, so now we're going to go and look at the distribution after our scenario develops. And here's our little scenario. And we not only look at the scenario as of the close, but also if price goes above the high, let's say on Friday, if it goes above Friday's high, come tomorrow on Tuesday, then we're going to see what the distribution of price is in those cases. We're going to look at the distribution if price descends below Friday's low. All right, and then that way you have a trading plan a little bit in terms of you'll have better statistics, more detailed statistics in terms of your decision making for these things. So here we go. Here's the likelihood report using statistical volatility. And let me get my little thing here. Okay, here's the historical distribution. This is as of the close on Friday. You can see here that as of the close, if you were to look at 171 signals, okay, it ended up hitting the upper 5-day band only 6% of the time out of those 171 signals. Only 6% of the time. Isn't that incredible? It only hit the 10-day upper band about 13% of the time, and it hit the upper 15-day band about 13% of the time. That's a lot less often than up here, than at the historical. You see that? Now it hit the lower 5-day band about the same, a little bit less on the 10-day and a little bit less on the 15 as well. So you'll see here that all in all, as of the close, it's hitting the bands just generally less often, particularly on the upside. Now, what if it goes above Monday's high? What if it goes above Monday's high? You'll see these numbers are pretty much very similar. look at this, very similar. It's not hitting any of the bands as often as normally historically here. And in the case when it goes below Monday's, or excuse me, when it goes below, well, actually it says here on Monday, it should say on Tuesday. I did put the holiday in. But basically, if it goes below Friday's low, it hits the lower band, or hits the upper bands less often again, and it hits the lower bands a little bit, barely more often on the 5. But all in all, you can see that the market is, it's predicted based on this market condition that it will have lower volatility in general, is what this is saying. It's hitting almost all the bands less often. Now, instead of using statistical volatility on the bands, one thing we like to do is use a skew-adjusted VIX to determine the bands and where they are. Now, the VIX is typically higher than historical volatility, and because you have higher VIX number is higher, the bands are going to be farther away and they'll be struck less often. And that's what you're seeing here. The historical distribution is that these numbers hitting the upper 5, 10, and 15-day numbers, these are lower than when we use statistical or historical volatility, right? So let's look at this. And if at the close, you'll see similarly, you have, let's see, similarly, you have the bands getting hit less often as well. All right. If the price goes above the high from Friday, the bands are hit less often in 5 of the 6 cases. And as well as on if it goes below Friday's low, they're hit less often, just as the same. So in almost all cases, the bands are getting hit less often. Again, lower volatility is being predicted, particularly to the upside. Lower volatility to the upside. And so that's the likelihood, the statistical likelihood, and you can always pause it and look at these numbers. But here are the volatility figures here. The raw statistical volatility for the last 20 days has been 10.6. The upside volatility is set at 11.2. The downside volatility is at 15.1. Now, using that downside volatility, that's simply a skew-adjusted VIX number. Here's an idea for you, a hedged bull-put spread. And what we do is we take the VIX, I look at the skew value that the SIBO kicks out, and come up with a downside volatility which is higher than the upside volatility, and break it up. I break up the VIX into 2 different predicted volatilities. One would be for the upside and the downside. And what we're going to do is take this downside one at 15.1, and we're going to use that and plug it into option view. Come out here and find the strike that is just outside the first standard deviation. Create a bull put spread there. Sell some premium down there. And then what we'll do is hedge that bull put spread with a bear put spread. And we make sure that after we do all this, we have a net credit for sure that gives us roughly 5-6% yield at least on 20 to 30 days out. And when you model this thing, here's what you get. Okay, you get roughly 5% coming in no matter how far the market goes up. And if it goes down less than a standard deviation, we'll make 17% here if you hold it to expiration. But remember, what it's saying here is that it's only going to strike this downside, or at least historically under this market condition, it has struck this downside short strike. Basically, I think it, well, let's see. We'll have to go back up and take a look at that, won't we? Just a second. Let me try that. Oh, I know. Boom. Sorry there. Click. Click. It hits the downside numbers. If it goes above the high, 25% of the time. If it goes below the low, about 15% of the time. And so when you run those numbers and you look at this then, okay, if it only strikes this level, 15 to 25% of the time, and 3 to 4 times, out of 5, well, actually, no, it would be 4 times out of 5, 4.5 times out of 5, you can see that we're going to make some, we definitely have an edge here. Okay, so folks, that is it. I appreciate you joining me. We'll see you next week. We'll post this thing next week on Sunday evening. Okay, thanks so much. Take care. Have a great week. Bye-bye.